I was talking to a guy who was a super successful entrepreneur from years ago. He'd taken money from VC, and he's like, yeah, they return my phone calls because I literally returned them like 400x.
Yeah.
And I was like, wow, that was such expensive money. I mean, it was like 8 years or something like that, right? But you're like, think about how expensive that money was for you. And he's like, I never thought about it that way. Entrepreneurs, like, we're trained to think about go and raise that VC money, but it's and it's not bad in the right situations. I'm not anti-VC, but if you can mix it up and keep smart ownership, it makes a huge difference.
Ignition sequence start. 3, 2, 1.
BJ, how's it going? I
going
appreciate
great.
You coming on the show.
Absolutely. Thanks for
I'm
having me.
pumped to chat Lighter Capital, essentially helping people raise non-dilutive capital to grow their SaaS companies.
Yep.
You've been doing it for a while, right?
Been doing it for a while. I've been doing it for about 7.5 years.
Cool.
Yeah. So we started early.
What have you learned about the SaaS financing space in the last 7 years?
How long do we have?
Yeah, we've got time. That's what I want to dig into.
It has evolved a ton. I mean, frankly, startup financing is always evolving, right? Today, most companies, when they're starting out, get convertible debt, for example, right?
Yep.
I was a VC back in the early 2000s. Convertible debt was nowhere to be found in those days, really that much. A little bit, but not much. Today, I think overall what we've seen is the rise of alternatives, and obviously I'm a little bit biased because that's where we sit, is alternative financing sources. And that's just nothing but good for founders, right?
Mm-hmm.
They have more options, more possibilities, especially with SaaS. And one of the reasons why we really early on started focusing on SaaS is because you can get to revenue pretty quickly compared to the old days when you had to go raise $5 million and then have a bunch of engineers and then you'd go and try and sell the product and oops, it didn't sell. And right. Or you had to go buy all the equipment and everything like that, right? So these companies become, they get to revenue faster and therefore their financing options are much more. They don't have to go and raise that, highly dilutive early equity round to go and actually build up the business and such. So,
and how many of you funded? 360?
We're at about 365 companies we funded with about 630 rounds of financing.
Total capital deployed?
Total capital deployed is 168 million.
Wow.
And we're doing...
It's a whole lot of equity that people didn't have to give up.
It's a lot of equity, and especially early equity, right? We're not replacing like a $40 million round. We're replacing like $1 million to $3 million like early round that's, you're giving up 25, 30% for that.
Yeah.
That's really what we're replacing. Or we're just complementing, right? Like, hey, you're going to raise $1 million from angels and you'll get $1 million from us. And you'll get way farther before you do that true Series A.
And what do you guys are willing to fund a third of their ARR run rate?
About a third of their revenue. Yeah. It's usually like 3 to 4 months worth of MRR.
Okay. And is there a minimum MRR?
Minimum MRR, $15K.
Yep.
We're working on some stuff that might go earlier than that, but as of today, it's minimum of $15K. So we cut $50,000 checks. I mean, last week we did a $50,000 deal. We did $1.5 million deal.
And what's the due diligence involved for that?
One of the things that makes us a little bit different is we've actually developed software to go and process these deals much more quickly and make it very methodical and very analytical and data driven. So when our customers, and we call them customers, we don't call them portfolio companies. When our customers come in, they apply, they give us a bunch of data. They ultimately just log into like their QuickBooks, they collect into their banking, all that kind of stuff. All goes into sort of an algorithm. Now, it doesn't mean that we're just cold people. We talk to them on the phone several times. We understand what they need, figure out what's the best structure to work for them, and things like that. And then ends up being like digital documents and the whole 9 yards. So we estimate it takes about 10 hours of total work for a founder. That includes talking to us, uploading stuff, talking to their lawyer if they get a lawyer involved.
Founders 10 hours?
Founders 10 hours.
Okay.
And talking to their co-founder, talking to their board members, like all that stuff is about 10 hours total time spent. So we like to say we cut down the fundraising time by about 90%. It's probably more than that because it takes more than 100 hours to raise an angel round.
Yeah, no, that's being generous.
Brutally painful.
And was it called revenue-based financing when you started?
It was. There wasn't really like an industry necessarily. There were a couple people kind of screwing around with it. It's kind of
like in the factoring, like you're selling, but it's
sort of
like potential getting paid with the subscription.
Yeah, it's much longer term.
Yeah.
So like factoring is more working capital. So like, oh man,
Yeah.
I need to go pay my
I got a
employee
purchase
today,
order.
and I've got a PO or accounts receivable, and I
I
just
gotta
need
buy
to
some
close that
inventory or
45-day
something. Yeah.
gap or whatever
You're
it is,
right,
right?
yeah.
Whereas we're giving companies money typically for 3 to 5 years.
Okay.
And so we're like, hey, you're going to go, most common use of our capital, hiring salespeople, doing marketing initiatives, and doing
Things that are
product
gonna grow
development.
MRR.
Yeah. So it's all stuff that needs to be longer term capital. They're paying us over time. And ideally, they're growing and they're paying us more later than today.
Yeah.
So that the payments kind of scale with the business.
And how does it work? Is it
And they're-
8% of revenue or something like that?
It varies, but
Okay.
it's typically somewhere between 2 to 8% of revenue.
Okay.
But the whole goal is basically you're going to go and have this money, and you're going to go and make investments in the business that are going to pay off in like 6 months, a year, 18 months, down the road a ways, right? Much like a round of VC does or angel round. But yeah, it's typically 2 to 8%. Our average customer has about 83% gross margins. So one way of looking at revenue-based financing is to say, okay, let's say it's 5%, just for ease of mental math.
Yeah.
Hey, I'm getting, say, $500K or whatever it is today, but my gross margin is going to go from 83%, right, down to 78% for the next 3 years
Yep.
or so, right? Can I deal with that? How much do I need to grow to make that worthwhile? And you don't really need to grow that much to make it worthwhile. If you're going to grow, overcoming that sort of, additional cost of goods sold in a way, you don't need a lot of growth to make it kind of worthwhile and make it work. And so, that's one way. There are a lot of different ways to think about money.
Mean, I'm thinking of the dilution on, and not, the fact that you're not giving equity. How do you? What's the simple? Is there a formula you give founder and say, like, if you're going to raise X and you do this versus waiting? Like, how do you help them think through it?
It's tough. We actually have some calculators that can calculate out like the value of warrants, the value of equity.
Totally.
So we actually have an online tool called our cost of capital tool, where they can say, hey, over the next 3 years, I need to raise X amount of dollars over X amount of rounds, and I expect to grow revenue from where I am today up to a certain amount over that time, and then we'll kind of calculate the cost of equity and the cost of our debt.
Because if
just
everything
show it to
goes
them.
well, it's expensive to raise equity capital.
Oh yeah, I mean, if you're a winner, I was talking to a guy who was a super successful entrepreneur from years ago. He'd taken money from VC, and he's like, yeah, they return my phone calls because I literally return them like 400x.
Yeah.
And I was like, wow, that was such expensive money. I mean, it was like 8 years or something like that, right? But you're like, think about how expensive that money was for you. And he's like, I never thought about it that way. Entrepreneurs, we're trained to think about go and raise that VC money, but it's, and it's not bad in the right situations. I'm not anti-VC, but if you can mix it up and keep some of that ownership, it makes a huge difference.
So back in the day, I mean, I'm kind of newish to the fundraising. Raised my first capital in 2009, so about a decade before that. Didn't even understand this whole thing. But there's Silicon Valley Bank. Back in the day, they would kind of, my understanding is they would ride along with the VCs, kind of like the VCs invest, so we'll give you some extra money as debt or whatever and take warrants, and that was the kind of their model.
Yep.
And since then, RBF and Tiny Seed, and there's like this whole new it's almost like financial. I'm not calling it financial engineering, but there's just a slicing and dicing the financial
financial
options.
innovation. Yeah,
innovation. Totally. How do you see these different categories of capital?
I'd say this, the way we often think about it, and I think to present to founders, is divide the world. If you make kind of your old quadrant diagram, right? So
2 by 2.
2 by 2. So on the x-axis, it's you're got a VC sponsor or no VC sponsor.
Okay.
And then on the y-axis, just revenue size. So we're basically in that kind of inner quadrant where you have no VC sponsor most of the time. About 90% of the companies we fund have not raised true VC, like 7 figures plus from a VC. SVB is very much, you have to have an equity sponsor, right? So we actually partner with them a lot because companies that are sort of in our target zone and in their target zone, there's this very clear delineation. Have you raised from a qualified VC? And qualified means qualified for SVB to go and give you funding. Because if you qualify for funding like that, it's going to come with a warrant, but the warrant's not that big from SVB. They're bigger from traditional venture debt, but from SVB, they're not that big. That's the cheapest money you're going to get is from a bank. And that's what you should do. They can give you larger amounts. They probably know the VC. There are good relationships there and stuff like that. That's wonderful. But if you're pre-raising that Series A from a brand name VC, that's really where our target zone mostly is. So like I said, 90% of the companies we fund are pre-Series A. About 45% are bootstrapped, 45% are angel backed. And so they squarely fit into that quadrant that's not venture sponsored, and then under typically under 8 or so, 10, 15 million in revenue. It depends on the bank and the different capital sources. But once you get up to 10 plus million in revenue, even if you don't have a VC sponsor, there are more different kinds of
Options.
funds available. I mean, we're growing up into that space and we love companies that are up in that size, but those companies can typically kind of go around to a bunch of different sources and find different things. There are
They've got a
funds out
history.
there.
So
They've got a
it's
history,
more
usually.
traditional business financing.
Yeah, and if they haven't raised a VC round, they're usually not burning a lot of money because they don't have much money to burn.
Yeah.
And so they may or may not be able to get bank money, but there are more and more choices in that realm. But it's really still hard to get debt capital for non-venture sponsored and less than, say, 10 million, especially less than 5 million in revenue is very tough.
And what happens? I mean, everybody wants to assume it's all going to be good and we raise money and we pay it back. But what do you guys do
when stuff goes wrong?
Yeah. BJ, what happens, man? You gotta
we break knees.
get some goons?
No. We I mean, the companies that we're funding, what is it? It's source codes and brain cells.
Yeah.
Yeah. What are you going to do? Like liquidate that? Can't do it. So, no, I mean, we have never foreclosed on a company. We've had it's really interesting though. Like our portfolio is very, very different than a venture portfolio, right? If you have a VC portfolio and you go fund, say, 10 companies, you hope as a VC, you're gonna have 2 winners, and then you probably have 6 that are like, got my money back. Yeah, and then you usually have a couple that are down. Like back when I was a VC, it was like 2-6-2 rule, right? Yeah. And so really it's like this heavily weighted towards these, the sort of power dynamics of VC stuff. Ours is completely opposite. We're not a home run hitter. We're like the masters of the single. Yeah. So far our loss rate is really low. We have very few companies that have just failed. Yeah. We don't disclose all these sort of numbers, but our charge-off rate's about 3%. Okay. It's about like a small business loan from a bank. It's really, and most of these companies go on and the companies that have paid us off, they'll be acquired. They'll go on and raise an equity round. Every once in a while, they'll grow up to the point where they're kind of more profitable and they qualify for bank financing. Let's pay us off with a bank loan, which is, they're getting money for 5% or whatever from a bank. It's great. And then we see our job is to kind of help companies grow out of that quadrant, whether they want to go and raise VC or whether they just want to grow up and get bank financing or something like that. That's kind of our mission, is to help them grow out of that tough spot where traditionally only money is equity.
Yeah. And do you guys have like today is there tools connected to their financial system so that way you guys can like dynamically adjust their payment?
Yeah, we just pull stuff out of APIs.
Wow.
So QuickBooks Online, Xero, et cetera, or even like QuickBooks Desktop, we've developed software where we can just suck in the information from that.
But that wasn't there 7 years ago.
No. We had to develop all that.
Isn't that cool?
Yeah, we had to develop all that and then analyzing it, monitoring it. So, I mean, the whole point of Lighter was to make it a lighter lift on entrepreneurs and then also a little bit of a play on like igniting your growth and things like that, right? But a lot of it is truly making it a lighter experience on the entrepreneur. So both fundraising and then just the monthly reporting. So like monthly, all the companies have to come in and submit financials and so that, but they just go like connect my QuickBooks Online again and pull it down. Like we finished the financials for June, connect it up, and we just like take it and we ask them a couple quick questions and that's it.
That's so cool.
Yeah, we suck the payments, like all loan payments are just ACH. We just pull it out and stuff like that. So it tries to make it easier on the entrepreneurs. I mean, it is. Like as an entrepreneur.
You just don't want to think about this stuff.
You don't want to think about this stuff. You want to think about product and customers and hiring and all that kind of stuff. All the stuff that makes the business unique, and then all the stuff that's just the same as anybody else, like accounting and certain aspects of HR and benefits and money and things like that. Like we're trying to help companies out with as much of that as possible.
And where does your capital come from?
Yeah, we have raised $120 million in funds to go lend out to companies, and we're allowed to then reinvest that funds. That's how we've deployed about just shy of 170 million.
Yeah,
it's because we just recycle the capital back into new loans. So started off with about a $20 million fund that was funded by a family office.
What was the check size when you guys started? Was there
50K?
Okay,
it stayed as 50K.
Yeah, you were deploying 50K, but what was the minimum you would accept?
Accept into funds. Actually, the way we've set up the funds, God, it's grown over time. Building a business like Lighter Capital, one of the huge difficulties is capital, right? Okay. Obviously, because if you don't have it, you don't have a product, right? And so when we first started off, we actually took equity money and we're funding loans with equity money that we'd raised. And then we finally got a family office in Seattle.
Meaning you sold equity.
We sold equity in Lighter Capital. Yeah. Actually, Lighter Capital is actually venture backed itself.
Okay, yeah,
well, it's an interesting thing. We have 65 employees that developed all this software and things like that to sort of change startup finance. So we're actually have raised 3 rounds of institutional equity. But we started started off, with just like a little pool of capital that was just equity money we'd raised to go and deploy it and sort of start experimenting with these loans. And then over time, we were able to get a family office to go give us at first $10 million, and then they agreed to add on $10 million. And then we raised a $100 million fund from a group that's public called Community Investment Management. That's actually based here in San Francisco.
Okay.
And they focus on
how much?
A $100 million fund commitment.
Wow. So you get 10 though from this family office.
Yeah, ultimately 20 from them, and then that's built up and already been almost entirely paid back.
What did they see in the model that they liked?
A nice, and this is the same for all of the investors in these pools of capital, a highly diversified pool of small business loans and companies that are relatively predictable.
Super. SaaS,
And I mean, it sounds kind of strange. Like you're talking about startups and I'm saying they're relatively predictable.
Yeah.
But in mass, as a whole group, when you got a portfolio of
if you get to
200
15K
of these or
MRR,
something like that,
there's like you've got a history and a track record of just like
totally.
Next month that's kind of coming in.
Totally. I very early on when I was a lighter, I sort of went and struck a bit of a partnership with Salesforce. And Salesforce used to train a lot of the ISVs that were building on the App Exchange, get to 10 customers and you'll never die. And I was like, music to my ears, really? Yeah. And they're basically like, yep, you get to 10 customers, we almost won't let you die, because Salesforce's end customers would suddenly have the lights go off on some features they liked, right? And so they were like, yep, we just
get to 10.
Tell all these things, get to 10 customers. And in a way, it's true, right? Like if you get to 15, 20K, it comes down to, founder longevity, really. Like, do you have the sort of stick-to-itiveness and the personal resources to keep through that sort of valley, the grind to get it to that point where it can actually pay salaries and stuff.
And what are some of the niche SaaS companies? Like, what are some examples that you find are just like so cool? Like, 'cause that's the greatest part is as software eats the world.
Yeah, it's
every
becoming
workflow,
more and more niche.
Every industry is.
Oh God, we see so much stuff. Interestingly, like one of the areas I just had never thought of software probably, and it was one of the most amazing businesses we ever funded, was church software.
Cool.
Like, I don't know, just trying to think about selling software to church.
Management and like communication.
Tithe management, so it had payments in it. It kind of had basically CRM and like membership management and stuff like that.
These
and
are
like
great businesses.
It's an amazing market. It's obviously a global market.
Yeah.
It's relatively stable.
Yeah.
Right. And if you can show them a positive return on the tithe, right? Like, someone asks you like, how much do you want to like give to your church? You're like, oh, I'll do like $50, and I'll do that every week or whatever it is, right? Yeah. So mentally, you're committing to $200 a month or whatever, right? Yeah. But in reality, you don't go that much in the summer, and you kind of skip it at certain other times, and sometimes you don't have a 50 and stuff like that. Whereas you just say, I'm going to do it every time, and they're going to pull it every time. Yeah.
Yeah. You're going to call the church and say, don't take it. Don't tithe this time. Yeah. I was on vacation.
Yeah. So.
That's so neat. I mean, I remember when I first started raising capital from VCs and realizing they had to go raise money.
Yeah.
You know what I mean? Like, I think founders don't realize like the people giving you money have to go raise their own money. So you have to go do the same thing they have to go through. So like as a CEO, what have you learned about just like scaling the organization to the amount of people and like the raising capital side, building the business?
Raising capital is a bitch.
Yeah. Because you have both the equity side originally, and then now you've got essentially the fund.
And we're
even when capital today is relatively as cheap as it's ever been.
Yeah,
it's still
tough.
Yeah,
and for us, one of the difficulties was we're dealing with really long-term loans. So you can say like, hey, we just went and made a bunch of loans, and a capital source would be like, that's great. Tell me how they worked out 3 years from now. Like, I can't wait for 3 years.
Yeah.
Right. It's kind of like being an enterprise SaaS business and a big customer saying, oh yeah, when you go sell that other customer in like 2 years, come back and tell me. You're like, that's not startup time. I can't deal with that.
Yeah.
Right. So, convincing people, just like any other startup, just like we had to go and convince people to,
and is it because it's such a
faith.
Small check size too? They'd rather deploy more.
So in general, in the money
right?
business, right? If you can go deploy lots, they'll give you money at a cheaper rate, and it's almost more readily available. Yeah. But when you're starting and trying to prove a new market and new structure, you got to get people that are willing to dig in and take a bit of a risk. And so that takes a lot of trying to find people. When for example, for our $100 million fund, and actually when we're doing employee onboarding and stuff, I go through this with the employees. When we raised the $100 million fund, we'd always raise the 20, right? So we had some bit of track record, but we'd funded at the time like $16 or $17 million worth of loans and such, and they were still pretty young. But when I went to go raise that fund, I pitched in person 35 different institutional lending sources. And after doing all that, some of them I was there like 9, 10 meetings and stuff like that. I was in New York every third week and in San Francisco about once a month and so that. I mean, all over the place because we're based in Seattle, but there's not money like that in Seattle. And out of all that, one term sheet.
Holy
And it's the one group we then worked with, Community Investment Management. They've been great. We then more recently went out and said like, okay, we want to raise a new fund.
Is there people that help like with relationships and connections?
There's
I've heard of this for like family offices. Like
there's some investment bankers and stuff like that, but it's so hard to know if you're getting somebody high quality or not. But when we went out to go and raise this next fund, which we're in the midst of hopefully closing out here really soon, we kind of worked, just first level networks and went out and so that and had like 8 term sheets.
Wow.
And like,
because you have a track record.
Yeah, you got a track record. It's all about being proven in the money business, right?
Yeah.
Just like, I don't know exactly how this works, but what I've heard is like Sequoia basically just calls up their existing LPs and says, tell us in the next 3 weeks or whatever, whether you're in or not.
Yeah.
You have to say whether you're in or not, right? Pretty easy for them because they've got an amazing track record.
Yeah.
Obviously we're nowhere close to that, but it's still the money game. It gets easier and easier. And
Where do you see the innovation going in the future for the alternative financing sector? Maybe some of the stuff you guys might be thinking about.
I think there's just going to be more and more and more very specific forms of capital for specific uses, and you're already seeing this. Some
for like
some
acquisition,
for us.
I've seen this. Like
some acquisition,
connect your Facebook account. Let's look at your
customer acquisition.
Return on ad spend, we'll finance just that.
Totally, exactly. And so people going in and saying, "Hey, I can go look at your Google Analytics and your Google, whatever your paid spend and things like that on ads, and I can see the ROI you're getting on it, and I can go finance that." More and more of the almost like niche uses of capital. So you can imagine if you're a startup founder, you're going to have kind of like your corporate capital that's whether it's your angels or VCs or whatever, or us kind of on that side of things mostly, or SVB or whatever stage you're at. But you might also have these sort of almost niche uses where, hey, we're selling on the Apple App Store and stuff like that. And we've got basically a factor that's paying us because they can see Apple says they got, 600 downloads and they're owed, $50,000 from Apple in 45 days. And so we'll go finance that. Okay. You're seeing more and more stuff like that just allows the startups to pull that capital in faster.
It's interesting because I remember when somebody was telling me on the Salesforce or on Amazon side when they'll lend you money based on like they know your inventory, they know your sales volume.
Yep.
I mean, as an entrepreneur, it's interesting to think like who are the people that have relationships with me that have data that can introduce opportunities to kind of finance.
Well, and for a lot of these big platforms like Amazon, if they don't do it, some other group will.
Yeah.
So I don't know if you've ever heard of Cabbage.
Yeah.
But Cabbage with a K, right?
Yeah.
So they do financing. They started off financing eBay sellers. Not that different than Amazon Marketplace sellers in a way, right? I mean, somewhat different, but they basically went after those eBay sellers because they could get all the scores and the track record and the history and everything like that and see that. And they've diversified off of that. But you see more and more and more of that kind of stuff growing up. And then obviously platforms like a Cabbage or Lighter Capital, where we're trying to diversify into more and more and more of those sectors where they can go and serve, the end customer in more and more and more ways.
Okay.
So, I mean, we're doing the same thing. We started off doing this revenue-based financing thing, which is cool because it's kind of like has certain aspects of debt and equity that are good for the entrepreneur. But then we've come out with lines of credit and just straight up normal term loans and stuff as well.
Really?
So and we're seeing that take off hugely. So we just announced and did a public launch of term loans and lines of credit in June. Okay. And as of August, revenue-based financing was less than half of the deals that we underwrote in August. Already it's just totally started taking off.
Wow.
Because go figure,
You've got a relationship.
You got a relationship. You know the company. Hey, we're willing to give you a revenue-based financing loan for $400K for the next 3 years. Yeah. But you have a bunch of AR and stuff too. Might as well give you a $200,000 line of credit as well against your AR, so you can go and finance all that too, because there's working capital needs and growth capital needs, and they're somewhat different.
So interesting.
I mean, just like it's like any other business, right?
Yeah.
If you've got a customer and the customer likes you and you've got
you.
a good relationship, just figure out how else you can go and
Create
serve
more
them more
value
and
for
more and
them.
more. Totally. It's no different than a SaaS business or anything like that.
Why did you move away from the VC space?
Me personally?
Yeah.
You know, I liked being a VC. It's
How long did you do it
intellectually
for?
about 5 years.
Okay.
It's intellectually super satisfying.
You get to see the future.
You get to see a lot of different stuff.
Yeah.
And who knows, I may go do it again someday or something like that. But I also like being an operator because you build something. As a VC, you're an indirect
Influencer
operator.
of the operator.
Yeah. I mean, you're working with CEOs, you're working with really interesting people and stuff. But at the end of the day, they're the ones actually taking action. And so you're very much an indirect operator, an influencer of things. I mean, VCs, to your point, they have to raise capital. They're actually building a business themselves too.
A lot of respect once I understood that.
It's a brutal business.
Yeah.
Especially today when there's a lot of money out there that's going. I mean, it's hard for entrepreneurs to go raise VC money, but it's also like for VCs to try and go get in the best deals, it's also super hard. And VC goes through these massive cycles of returns, right? During the .com era, they made massive amounts of money. And then for the ensuing about 15 years or so after that, VC returns were generally speaking pretty bad. And then, they've come back in more recent years when the sort of SaaS has come forward and there've been more IPOs and things like that.
Do you think you can get the loans to a point where it is a click approve?
For certain types of loans, possibly. It's really fascinating. And this may change over time, but our customers want to talk. Like they want something that's fast, just like all of
even
us.
SaaS products, like if you're at I feel like $250 a month, like they want to talk to you.
Yeah.
Like if I'm going to spend that kind of money, I want to know like the use case that I've got and your thing. Is it going to work?
Totally.
Yeah.
Exactly. It's exactly the same. So like in general, sort of
for them, you may be the first time they've taken money.
We are very, very frequently the first institutional money that they've taken. They've gotten money from an angel or whatever and stuff like that, and they raised it off of like a pitch deck and a model.
For them to sign some legal paperwork and commit.
Yep, exactly. And they commit, they have to give us financials each month and all this kind of stuff, right? So we have to go in and understand all that. And we're good at understanding messy stuff, obviously. But a lot of times it's the most formal kind of process they've ever done to go and raise capital. And so, it's something that at some point in time, if you're going to do really small stuff, you could start to do click, but customers want to talk
to somebody.
Yeah. It's a very interesting thing. One of the issues we face in our business is how do you build trust remotely? Right? Because most financing sources, you got to go and pitch them and meet them. And it's all about, do you have chemistry or whatever? And we're like, no, we're trying to take all that hassle out of it. That's also the process through which you build trust.
Yeah.
So we're doing a lot more things, kind of like SaaS businesses, video conferencing on Zoom, all that kind of stuff. So you can sort of start to build trust with stuff while we're trying to like build trust and yet not be obtrusive, trying to be lighter on them, right? So I do think we'll probably end up with some products that are click, but they'll be on the low end in terms of size.
Essentially lead gen.
It's
like, get them in the door.
Get them in the door, build some incumbency with the customer, understand them, and then as they grow, start to be like, okay, hey, now you could probably qualify for this and you qualify for that. And they just start a relationship, right? It's amazing, even for us, you think you know a business and stuff like that, and you give them money, and then march forward several months after giving them money, you tend to know them a lot better.
Yeah.
And it's just life. It just happens that way. As much as we've got all this fancy software to understand them, like when you see them actually go and perform after you've funded them and what they're doing, what their concerns are, and talk to entrepreneurs a little bit more, you just understand a lot better what's going on, and you start to build that bond all the more. And that just helps you serve them better.
How much of what you guys have a model, is there negotiations involved?
A bit. Yeah.
Okay.
We usually have about 4 phone calls from kind of, first touch to money in bank. First one is really more of we've just kind of got a sketch of the company and understand, do they kind of meet our rough criteria? And that's totally are we good for you and are you good for us?
What
it's
are red
very
flags
mutual
for you guys
thing.
at that stage? High churn?
Our biggest red flags, high churn is tough to fund, but it's not like a huge red flag. It's just kind of like, hey, that's difficult.
Yeah.
It's so one of our criteria is we want to see something that's kind of roughly benchmarks out well with a certain cohort. Like if you're selling enterprise, we expect lower churn, small business, higher churn, consumer, way higher churn.
Okay, so just meet within some.
Yeah. Are you within the general parameters that make sense? The biggest red flags, I mean, there's basic criteria at that stage.
Right? A lot of
They
people
fit
think
or
they're
don't.
SaaS or not SaaS. I don't know why. That's just like the weirdest thing. They think they have a subscription business. And,
And they don't.
you're not SaaS. You're not a tool.
Yeah.
Just because you have a subscription doesn't make you a SaaS.
Well, and we'll fund stuff. We just want to see recurring, so we don't care if you're technically
so you
SaaS
guys are
or
cool
not.
if it's not just.
Yeah, we do a lot of like tech-enabled services. We're starting to do even more like tech services type of stuff. So just we started with a beachhead market and then broadening, right?
Yeah.
But at the true red flags, besides sort of the quantitative type of things, are just the person. Mm-hmm. If you're talking to somebody and they're talking about how they're going to be bigger than Uber next year, cuckoo, just stuff like that.
You've probably seen a lot of that in the VC.
I mean, you see a lot of that stuff all over the place. Yeah, when I was a VC, I was a VC in clean tech, and I literally had a guy who was introduced through a friend scream at me in a bar saying, "You don't know what you're fucking missing, man. You don't know what you're missing. I'm going to be the next Yahoo." This is a long time ago, right? And so like that when Yahoo was still huge. And so I'm like, I'm a clean tech VC, and you're like a portal. Like I just can't.
Yeah.
And he just couldn't take it. Couldn't take a no. So we'll see some red flags, like people are just a little wacky, and entrepreneurs.
It's interesting because sometimes they're wacky and good.
Yeah.
They can be wacky and bad.
Yeah, totally. Entrepreneurs by their nature are wacky, but wacky is not necessarily a pejorative term.
Yeah. How do you compete? I mean, as more people have gotten into this space, how do you guys think of differentiating the way you guys do it or what you do?
Yeah, it's an interesting question, right? Because at the end of the day, money's just green, right?
Yeah.
It just comes with
that's
it
the
just
thing
comes
about
with
financials.
terms.
Yeah,
it just comes with some terms. It's some structure, right? And so it's just money. That's just a fungible commodity. Yep. And then there's terms and structure around it. And then there's like the group or the person or whatever. Do you trust them, right? Like if you end up, exactly. Like if you hit the edges of some covenant or whatever, are they going to just foreclose and be a bad actor, right? Yeah. So we obviously focus a lot on making sure that we're a good actor and then keeping the structure in a way that's, works with our customer really well. Yeah. All that sort of fundamental stuff. But yeah, as more and more money comes into the space and finds that it can get a return there, it gets more competitive, and you can compete in a couple different ways. You can either be, more customer centric, which we try to do and try and be better with them. So we measure our own NPS and stuff like that.
Cool.
Yeah.
That's
so
awesome.
we have an NPS. We had a baseline NPS last summer about 63, and now we're at about 70.
Great.
Yeah. So it's pretty high.
Financial.
Yeah. You know what? Bank of America's
like AT&T. These are all like single digits, if not zero.
Yeah, they suck.
You're in the Apple
Amazon-ish type
That's
category.
amazing.
But then really listening, right? Because even we have people that'll say on an NPS score, okay, they give us a 6, and they have some critique. Like, okay, we want to know what that is, and go try and figure it out. So anyway, making sure that you're very customer centric and stuff like that, because obviously that builds trust and gets customers. You can compete on kind of terms, but that gets dangerous, right? And
then you fall out of your wheelhouse.
You fall out of your wheelhouse. In the long run, there's going to be a downturn at some point in time. We don't want to collapse and stuff, right? And then the other thing is just what more can you actually provide the customer besides just, a friendly voice and good terms, all that kind of stuff. And so we focused on that. We have a whole initiative called More Than Money for this exact purpose.
Value add.
So we've lined up a whole bunch of what we call perks. So if we fund a company, they can get free Amazon compute time, AWS compute time, $10,000 worth. They get 90% off HubSpot the first year, and so we've got a whole set of kind of perks that they can get. And that was really sort of twofold. Number one, can we go and they can get sort of these free things and stuff like that, and most of them are all. They're all the tools that a lot of the SaaS businesses want to use anyways. And so can they go get a discount? And of course, the providers of those love to go and do that because they just want it. It's just lead gen, and they're perfectly willing to give up some of the first year, whatever it is, to go and get that. Number two, the other thing we found, of course, is a lot of our customers sell to small businesses, and so they want to be listed in that kind of little marketplace of things and get the promotion that we do for that whole system. So a handful of our customers that we've funded are then part of our
perks.
Yep. So hey, if it's a lead gen for them, it's great.
Ecosystem.
Yeah, totally. And of course, we don't.
Have you guys ever done an event as a value add?
CEO summit. We've talked about having a lighter capital conference and getting them all together. Yeah, we definitely need to do that.
One of my investors did that, and it was one of the most valuable things he ever did.
Yeah. It's definitely something we'd really like to do because
everybody's same mentality. Because
totally. And a lot of times we can see it when we go and meet customers. Like we don't have to meet them to go fund them, but it's a small
Be
place,
nice.
right?
Yeah.
And so at a SaaSer conference or like here at SaaS Doc or stuff like that, you do meet up with them, and it's pretty interesting. I remember one time I was at like the second year of SaaSter, and it just epitomized like our customers to me. I was supposed to meet one for lunch, and we're just meeting at a conference around a little table, and one of the other founders that we funded happened to be there, and so we were starting talking, and so the three of us were talking, and the next thing I knew, the two of them were just talking, and like they cared a lot more. They were trying to figure out what's the equity portion I should give to some key hire I want to give, and like. One was wondering about it, and he was like, "Yeah, the person's asking for this much," and the other guy was like, "No way, I would never give more than this." So that, like,
solving their own problems.
It's lonely being a CEO.
Totally.
It's super lonely, and going and finding people that are facing the same issues and they're not being judgmental of you and stuff like that is really rare, right? Because you go raise money and you got investors, and they're always judging. I mean, it's their job,
and their bias.
Right? Yeah, and so. And your employees are always judging, and your customers are always judging, and stuff like that, right? And as CEO, you're always on stage, but with like a peer that's facing some of the same stuff, they feel really good and open that they can go share, the difficulties and get good, solid answers, right?
Yeah.
So much of this stuff is so hard to benchmark.
Yeah.
Like what is a good percentage to go give it to a key executive, or, how do you climb your pricing scheme up on existing customers?
Yeah.
Or
That's the right way
all
to
that
do that.
stuff.
Yeah.
So they get a lot of value. I mean, we're just a conduit,
Yeah.
right? Obviously, in some ways, but they get a lot of value out of talking to
So
each
you guys
other.
have talked about a CEO summit.
Yeah,
Of sorts.
every year we're like, should we do it this year? Should we do it
I
this
think
year?
the year you do it, you'll be incredibly.
Yeah.
Like it's like, to me, it's getting founders that are on that shared journey at that moment, because it sounds like you have a very specific type of customer. So there's nothing like somebody that curates that.
Yeah.
Right. Where it's like you get in a room, you're like, holy crap! It's like I came home to the mothership.
Yeah.
And you can talk in shorthand and just and especially now that you've got those other loan
products and stuff.
Yeah. So the ones that are using it will essentially upsell the other ones. Like, hey, you should get this thing.
Yeah.
As a CEO, and an entrepreneur, who have you needed to become to be the person that continues to lead? It's a heady question, but it's a lot, because that to me is
I mean, listen, as an entrepreneur, right, you're always having to like evolve, right? And the more successful you are building the business, the more quickly you have to evolve, which is exhausting, right? And actually, I remember in your speech you was giving, you were talking about how the first couple of years you had certain sort of flaws, and you had to like go figure those out. I mean, we all do it, right? It just depends on is it flaw number 1 or number 7 or number whatever it is. We all go and do that, and so it's just constantly figuring out like what's the next sort of adaptation you need to go do, and are you going to be really good at going and doing it, and if you're not, how are you going to make up for that, and what is like the best step for the business?
And what were some of those for you?
God, so many. It's like almost hard to think of individual ones. I mean, there's always like letting go, right? Letting go just as a general theme. When I started Lighter, there were 3 employees and me, and we did
you mean like
everything. Delegating off, and delegating off in the right way, right? Not in a, there you go, I come back 30 days later, how come you're not done it perfectly the way I would do it, right? And so, not being the constriction point, and just like the process of letting go is always just not necessarily hard, because you want to go do it, but doing it in the right way and choosing the right things to let go and the right people to let it go to, and doing it in a way that you're setting up for success and not for failure, and all those sorts of things. I think those are the things that often consume a lot of our time.
That, like, you almost got to do it and get a feedback loop going.
Yeah.
Right? Because you just brought up a really great point of like, did I delegate the wrong things? Because if you give away something that's critical and then it's like, oh, my business didn't grow because I gave away this critical thing. Maybe next time I shouldn't. And then there's some people, they get, delegation happy, and all of a sudden it's like nothing,
nothing happening.
People are overwhelmed. Things aren't being done.
Totally. And then, you build obviously all these expectations for people,
and the team's
right?
60 now?
Yeah, it's about 60, 65 people.
Yeah. So you've had to learn. And you're saying in the early days, this was a challenge for you.
I think it was a challenge for me. I think it's a challenge for lots of folks. Like I don't know that I was particularly worse, but I was probably worse, at this particular thing at this time.
Yeah.
Like we all kind of have our terrible points of doing that stuff, right? Of like, hey, okay, I think I can go give this away, and I'm going to give a bunch of latitudes. I think that person can handle it. And then all of a sudden you realize, oh my God, I gave so much rope, and they hung themselves with it. And now I've got a problem where some critical thing isn't done, and this person's not doing well kind of spiritually, emotionally, because they just botched something.
They
right.
failed. And it's not always their fault. It was.
Totally. I mean, I'd say just in general, like a stressed out but successful entrepreneur is always looking at like, what did I do?
Always.
Like, I mean, you can't be, Trumpish narcissistic about it, but you've got to be like looking and saying, okay, how can I take some ownership for how that ended up happening, right? That I've never had a problem with. Like, I was a pretty sort of self-reflective guy. Yeah, like I was probably more on the overly stressed side. That was one thing too, like turning off. I'm not good at turning off. I just came back from the longest vacation I'd ever had in 7 years by far. 2 weeks.
Wow. And
2 weeks.
Full turn off?
Come
on.
Not full turn
Emails
off.
in the morning?
No, yeah, totally. Completely still.
I love the emails in the morning. My rules is if I can get it done before the family wakes up, then it's fair game.
Yeah.
I'm not taking away from them.
Yeah.
That's my rule.
I even broke that. So
No judgment.
Slack and whatever else. But I did go 10 time zones away, and that really forced some break.
That's a forcing function.
Yeah, we just went to Crete and to
Nobody's
Paris.
there to talk to.
Nobody's there to talk to.
They're still sleeping.
So in the morning when you wake up and looking at it, you're looking at yesterday's emails and stuff like that, right? Basically for the team. And then you're giving them certain responses, and you don't have that like, I just responded to this thing and then something else came at the top.
Yeah.
Right. So you're doing your look through, your responses, and that's
go do your day.
Yeah.
Yeah.
And then by like, the time they're waking up, you're like, no, I'm going out to dinner now.
Do you feel like you're getting better at that? Turning off, with the family?
Somewhat.
Yeah.
But I tend to dive in.
Yeah.
Like I just do that in life. I've always done that in life.
Full on.
I'll just go dive into stuff. I decided that, when I got out of college, I decided I wanted to go and move to Taiwan and learn Chinese. I've ended up with a master's in Chinese political economy, and then was like, do I really want to do this?
Wow.
And then shifted gears into funding and building startups.
Yeah.
So,
as a CEO and leader, how do you think about innovation for like where you're going to bring things next? Like essentially sequencing, because I believe that success is a byproduct of sequencing recipes, same ingredients, different order. You get a cake, the other one you get a mush, right? So like, how do you prioritize, or how do you think about strategic prioritization for
the company?
Yeah.
In terms of like long-term strategy,
stars,
or just what we're kind of building.
Yeah.
One of the things that we've really been focused on recently is building out more core competencies. So, for example, we're in a funding business. So, of course, the first thing you have to be good at and build up is the ability to fund the right businesses and, get money into them and not fund the wrong businesses, right? So, a whole lot of time and effort around
loan origination.
Yeah, loan origination. Can we go and like attract companies, bring them in, and fund the right ones and don't fund the wrong ones, right? And so we built this whole system around that, and we got really kind of good at that stuff. Everything from customer acquisition piece and building awareness and a brand and all that kind of stuff to that. But what we were not really good at, and we're trying to get much better at, is just general project management, product management, things like that. That if we were like an enterprise SaaS business or something like that, we probably would have focused a lot more on product and stuff like that. But now we're at the point where we want to develop all these other things we're going to offer these companies. We got to be good at managing a sort of a portfolio of products.
Yeah.
And so that takes building other skill sets, just building other muscles, right?
Totally.
And also just as you're getting larger, just having more of that project management competence and things like that, so that you've got systems in place to go, hold people accountable and organize things better and things like that. And so just building up those other competencies at the business that will allow it to grow and scale, over geographies and into more target markets and things like that over time. That's really what we're mostly focused on, so that we don't just come out with a line of credit and term loan, which we did, but those are sort of our first products after this revenue-based thing, and it was painful for us to come out with that. I mean, not surprising, not like anything shocking or whatever, but when you aren't accustomed to doing that kind of thing and you go do it, it's a new muscle you're building. And but we got to get way, way, way better at that kind of thing and just rolling that stuff out. And so that each year we've got several new products coming out, like whether we're going to do some credit cards we're looking at, or whether we're going to launch into new geographic markets and things like that. That's stuff that's, we just haven't developed those muscles all that well yet.
But you kind of know this is where we're going. Here are the muscles that we need to develop.
Yep.
Product is one of those. Yeah.
Yep, totally.
That's
So
really
you're
cool.
gonna have multiple financial products and some things that are more than money as offerings to these companies, and then you're going to do it over multiple geographies,
really
right?
cool.
So most likely entering Canada later this year,
Yeah.
maybe beginning of next year. We're also looking at Australia, the UK, some other markets. We have a really close partnership with Silicon Valley Bank, and they've got folks in the UK
They're
and also
international for
in
sure, yeah.
in Germany and Israel.
Yeah.
Partnership in China, and that'll probably take us a long time.
Yeah.
But
There's enough opportunity in the other.
and there's enough opportunity in other places. But then, now you're facing the issue of now you're going to have a remote workforce operating over multiple different time zones.
Whole new set of skills.
Whole new set of skills. As of today,
That's fun.
every single person that we have is in Seattle.
Really?
And we've looked at hiring other places, and we decided, you know what, we're just not mature enough yet.
Not there yet.
Nope, we're not gonna be that successful at it.
But it's know thyself.
Totally know thyself and know, like, as entrepreneurs, in some ways, we have to be insane to go on that journey.
100%.
But at the same point in time, you have to have an accurate enough sense of yourself and your organization to know, like, okay, how far can I push?
Yeah.
And so, yeah, those are some of the things in front of us.
BJ, where can people follow along online? We're going to reach out. Lighter Capital, obviously. Go check it
Yeah,
out.
we're all over LinkedIn.
Yeah.
Like, LinkedIn is really our biggest thing. I mean, we'll do stuff on Twitter some and Facebook some and things like that, but LinkedIn is really more the centerpiece for us. Just
And
'cause,
you've been
people
to
think
every
about business.
SaaSter, so you're going to go.
SaaSter. We'll probably do more of these SaaS talk things as well.
Love SaaS Talks, my favorite one.
Yeah. And SaaSter, we've been to all the SaaSters. We'll probably always go to SaaSter.
Yeah. Any other SaaS events that you guys are evaluating that
We're looking at some in Canada, SaaS North.
North.
We've heard is pretty cool.
I'll be there?
Yeah.
Yeah.
And
Pretty much, if it has the word SaaS in it, I'm usually speaking.
you're there.
Yeah. I liked it when Patrick Campbell had SaaS Fest. I like that name better than Recur. If you
Yeah.
haven't heard Recur, that's another good one.
Yeah.
Yeah, it's neat, the proliferation of events in the SaaS space
It is.
all over
It
the
is.
world. Yeah, I think Alex from SaaS was telling me that today there's one in Berlin and Paris.
Wow.
SaaS specific events.
Yeah.
So as you roll out your geographies, there'll be a built-in distribution network for you.
Yeah, exactly. I mean, and it's a great way for us because although we focus on acquiring customers much more, indirectly and online and things like that.
Yeah.
It's awesome to go and actually meet people
In person.
And I mean, they want to know, kind of back to our earlier conversation, they want to know you're like real.
No, like, and trust. Awesome.
Totally.
BJ, I appreciate you coming on.
Yeah, absolutely. Thanks so
All
much.
right. We'll talk soon. Cheers.
Thanks for watching this episode of Escape Velocity. Be sure to like and subscribe and leave a comment with your biggest insight from our conversation. Be sure to check out the next episode.